A warm welcome to this episode of the Watch Dealers podcast. We've really been looking forward to today because today we're diving further into our investment discussions. And on that note, we have two guests from Sydbank joining us. We are joined by Ulrik Knudsen, who is the head of business at Sydbank, and Søren Kristensen, who is the chief economist. We'll start by hearing a bit more about them.
My name is Ulrik Knudsen, and I am the head of business in our branch at Stortorv in Aarhus. I have worked as head of business for the past 6 years at Sydbank, and in total I have worked with business clients for 23 years. At Stortorv we have a department with 18 people who serve business clients, and that ranges from sole proprietorships all the way up to large corporations with multi-billion turnovers.
And Søren.
Well, my name is Søren Kristensen, and I am the chief economist at the bank, as you mentioned, and I have been at Sydbank for about 8 years and have been chief economist for the last 5 of them. On a daily basis, I lead our analysis department under asset management, where we have some economists and some equity analysts. We actually also have a consumer economist here. So we cover everything from how you put together your meal plan to which stocks you should buy. So it's quite a broad range, and I myself primarily deal with macroeconomics and much of what we're talking about today.
It's really interesting to get a professional perspective on the world from your point of view, because even though we primarily focus on watches, we also focus on investment. And I often like to boast that watches are really, really good in good times and often even better in bad times. And that's the discussion we've touched on earlier in this podcast series, that when things are going well and Master Mason Hansen generates a certain surplus in his company, then he might go out and treat himself to a nice watch for himself or his wife, or maybe even for both of them. Whereas in slightly tougher times, there are many who seek the safe haven in watches and the capital preservation that can happen there. So we have that opportunity to both have our cake and eat it too when it comes to watches. But even so, it's still interesting to hear, how do you gauge the current climate right now? How do you see the market, and what on earth do we expect from the coming quarters if you ask the smartest minds at Sydbank? Søren, a few words on where are we in the world right now? How is everything going? If you could just boil down the last 30 episodes of Millionaire Club and into 5 minutes.
Yes.
How do you see the whole situation?
Well, I would say that right now we are kind of at a crossroads, you could say, because we've just come out of a few years with really, really high inflation and sharply rising interest rates. And when we were standing there about a year and a half ago, I think most people agreed that interest rates were only going one way up, almost in a panic among the central banks, because they simply wanted to do everything they could to stop that inflation as quickly as possible. And if we look back in history, they've always succeeded in doing that. They have never succeeded in doing that without causing a recession. That is, a sharp downturn in the economy where a lot of people have lost their jobs, the stock markets have struggled, and generally speaking, many investment areas have had a really tough time. And that's why I think most people expected that this was what would happen about a year and a half ago. And I have to say that included ourselves as well. But that just hasn't really happened. We've actually seen inflation come down a lot. In Denmark, we're below 2%, which is basically the target. That's not quite the case yet in either Europe or the US, so they haven't fully reached their goal there. But they're very close, and at the same time, the economy hasn't fallen off a cliff. People still have their jobs, and things are still going reasonably well in the economy. And that actually makes us a bit more optimistic. We have a relatively positive outlook for the future because the major blow, especially from these interest rate hikes, has more or less been absorbed both in the economy and in the financial markets, and that means we can start to look a little bit ahead. The reason I say we're at a crossroads is that we haven't really reached the point where we can say that inflation has truly been brought under control. Now we can start lowering interest rates, and now we can really start looking ahead at the economy. We're still not completely sure whether enough has been done to break the back of inflation. To put it a bit bluntly, things might still be going a little too well, especially in the US where there's still too much demand for a lot of things, and that means there's still inflationary pressure, you could say. So that's the crossroads we're at right now.
Interesting, Søren. You say that people have good, healthy expectations for the future. When is that? When is the future? When you say we're at this kind of crossroads now, are you thinking 6 months, 6 years, 3 quarters ahead? What does your gut feeling say?
Well, we're probably closer to the 6 months, so it's actually quite imminent. You could say that for Danes, I actually think we're already well underway with it. I mean, we're at a point where things obviously aren't going as well as they did a few years ago because we've all become poorer. Prices have risen more than our wages have. Interest rates are still high. But if we look at the development, the momentum that's there, it's actually moving forward right now. Wages are rising much faster than inflation, or rather than prices are. And interest rates are also, at least some of them, starting to come down a little. So we can see that there's starting to be a bit of a tailwind, and those consumers who were really hit hard by having to pay 30 kroner for a pack of butter and cut back on a lot of things. Well, they haven't started to ramp up their spending yet. It's not at the same level or pace as it was in 2022 when things were really booming and we got access to our holiday pay and those kinds of things. But it's still quite reasonable, and most importantly, we're actually seeing progress right now.
Exciting. That does sound reassuring. One could cheekily say that it also sounded reassuring 6 months ago when we were looking 6 months ahead. And maybe that's the stagnation you're mentioning, which we might either be on our way out of or about to move past very soon. At least we are experiencing an increase in revenue compared to last year, which is starting to resemble more and more the year before that, which actually was a pretty good year. And we also base this a lot on what we see in our end customer department, at least, that we're dealing with a consumer who might be more conscious about how money is spent, but who may be more inclined to invest in something that retains its value over time rather than spending it on a trip to Mauritius as things stand right now. That's perhaps a bit of what we're experiencing. That sense of restraint where people are actually willing to put a certain amount of capital preservation into a watch, but maybe are less willing to go all out on a massive spending spree. Ulrik, what do you think? What is, if we take the pulse in a more, I was about to say, down-to-earth and tangible way. Now, I'm a shopkeeper over on the other side of Stortorv here, and you are a banker just downstairs from where we're sitting. How is the mood here on, I was about to say, on the floor out at Stortorv?
Well, we're sitting in a department where there are 18 of us working in business banking here at Stortorv in Aarhus. We serve about 2,000 companies, ranging from the very small sole proprietorships to large corporations with billion-kroner turnovers. And I'd actually like to say, following up on what Søren said, that we find that most are doing well. They are still making money. They're not making as much money as they did last year or in 22. But there isn't really a major crisis going on. Of course, there are some who have been left with large inventories, which they built up during Corona when sales were really good, especially physical goods, and they're being affected a bit by interest rates now. But most of it is something that can be managed. So the general picture is that the companies are doing well. They're not making quite as much money as they did 2 years ago, but still at a decent level.
Søren, we're currently writing these new articles about how we see the world and why one should be exposed to something very low in volatility, safe, and relatively high-yielding like bonds. And when we do that, we look, so we can, it kind of stands out to us, and it's very, very easy for us to use this argument about the extremely high P/E ratio, especially in the USA. These are some expensive stocks. Can you say a few words about this stock market? Is it as expensive as we think it is? Or do you, from your side, have a different opinion and a different perspective on it?
Yes, well, I have some colleagues who spend a lot of time looking at the stock markets, and their view fundamentally is that it really is very, very expensive as well. When we compare it to how expensive it has been in the past few years, well, then it really is very expensive right now. And when you look at the scenario that the market is painting for the world, a scenario where interest rates are supposed to gradually fall, and at the same time, earnings are just supposed to stay where they are, or actually increase quite significantly. And then we might have a hard time seeing how it all really fits together. That is to say, we are also a bit skeptical about how highly priced the stock markets are. So it's more in the smaller niche stock markets that we're looking to find somewhat better return opportunities, because the broad markets are relatively expensive at the moment, and even though they could easily become even more expensive, we also see it this way. When we look a year ahead, we don't really expect overwhelmingly high returns from the stock markets.
It's incredibly reassuring for us to hear this from a professional in your position, because when we're sitting here writing in our little humble marketing department, we can often become a bit blind to our own subjectivity. And so it's actually good because we can basically just Google our way to the answer we want to see and hear. That's just how the world works these days. So it's actually good to get some words on it. And now, over the past episodes in this podcast series, we've talked a lot about the watch dealer Invest and who we exist for, and that it's both an alternative for the semi-professional and the professional investor. And I know that you, of course, also work a lot with those types of clients in private banking and in other areas at Sydbank. If we look at it a bit more operationally, are you starting to notice that collectibles, meaning investment in physical assets, are becoming more significant among different investors? Or is it still such a small area here in Denmark that there really isn't any focus in that direction yet?
Well, you could say that what our investment advisors primarily focus on is stocks, bonds, and securities in general, which we provide advice on. In addition, we know that many of our private banking clients also have other assets, These can be cars, art, watches, which they invest in. Many also have a rental property on the side, and all of this is to spread their risk. And you could say that if it's wine and watches, well, then there can also be some enjoyment in it as well, you might say. So it is definitely our impression that private banking clients take a very broad view of their investments.
Mm-hmm. And that's also what it is. That's also something we're learning the further we get with our handler and invest, that it's not necessarily watch nerds among our investment clients. It's your clients from private banking and others in the same situation who are looking for something, some diversity and some risk diversification and something less volatile to put a smaller part of their wealth into. And it's actually funny when we hold these events for our investment clients and look around the table and ask, who is it exactly that's sitting here? It's usually owner-managers, typically business people, and if I'm being really blunt, there might be a couple in the making, but otherwise there have been zero nerds at the table. That's something they've become afterwards, just as they've probably gotten better at drinking wine, tasting wine, and all sorts of other things, whether that's the path you go down or vintage cars or something else entirely. And I find that incredibly fascinating, that it's not necessarily the interest in the product itself in this context, but rather the interest in the tool and the dynamics behind it. And I think from an investment perspective, that's extremely healthy for our humble venture, that people are here for investment reasons, and if I may be a bit cheeky, with their brains rather than their hearts.
But as we also talked about earlier, the private banking segment in Denmark is actually one of the areas that is growing more than many other departments of the bank, you could say. So there is extra focus on being able to offer a wide range of options to our clients as well. And among these, one of the things we communicate about is, of course, alternative investments.
Speaking of our latest blog post, we've been looking closely at Knight Frank and his models regarding these ultra-high net worth individuals on the planet and the growth of that very group. That is, how many wealthy individuals on the planet who in illiquid assets are worth more than $30 million, and the growth of that group. And if you look, well, it's a bit of a longer story, but if you look at it statistically, for example, Rolex, if we relate it back to watches again, it's estimated that they produce about 1 million watches a year and are currently reportedly building a new factory. They're very secretive down there in Switzerland, but reportedly they're building a new factory that will increase capacity by about 30%. So by 2028, they might be producing 1.3 million watches a year. And if you look at this model in relation to how many ultra-high net worth individuals there are on the planet and how many are estimated to be joining that club in the coming years, well, then the growth is actually higher than the increased capacity Rolex will be able to deliver from the new factory. And that actually means that per wealthy individual in the world, there will be fewer brand new Rolex watches available in 5 years than there are today. And of course, that's an interesting angle to consider as an investor, especially in terms of what you include in your portfolio. When we talk about watches, should you include something brand new that actually appreciates more over time? And there are really many reasons to look in that direction. But most importantly, it's also a question of how many people with purchasing power there are on the planet. And you don't need to be worth $30 million to buy a Rolex watch, because if that were the case, there wouldn't be many watches sold here at home of the ones we actually sell a lot of on a daily basis. But is it, when we sit here and rely heavily on this report, and I know that many others who work with collectibles, including wine investments and others here at home, also rely heavily on him. Is it the same perspective you have on the world from Sydbank's point of view, that there are more and more wealthy people emerging on the planet?
Yes, I think that's completely fair to say. That's also a development we've seen over the past many years, and I'm absolutely certain it will continue, which also creates this broader demand for many things. So, not just for stocks and bonds. I believe that completely, without any doubt. And when it comes to watches, you and your team know much more about that than I do. But I think you're absolutely right that it's basically in two categories. It can be something you buy to wear, but it can also be an investment case. And the more people there are who can create high demand, the more people will actually come into both categories, and we definitely believe that's true as well.
And if we look at little Denmark, do you work with numbers on how many wealthy people there are here today versus how many there will be in just a few years? Or is it such a small number that it doesn't necessarily affect the bigger strategy in the banking world?
Yes, it is a small number, at least when we're talking about investments. It's not something that affects the strategy we have regarding how we invest in the bank, simply because there are so few of them, and because it's maybe a bit more about where the general population is, and not so much about who stands out or how many stand out from the general population. But of course, it does make a difference in other areas. For example, the departments of the bank that handle these wealthy clients. There, we are seeing really strong growth, and that can certainly be a reason to pay attention to it.
And speaking of growth, we're also looking at things like consumer confidence, which we've worked quite a bit with in our latest blog post. So you can actually draw some fairly proportional lines between consumer confidence in 2022 and 2023 versus our revenue in 2022 and 2023, at least on the end customer side. That consumer confidence is proportionally heading to an even better place in the coming quarters. Just as you mentioned earlier, the economy in general is as well.
Yes, I definitely believe it is. And it's actually interesting what you say about how consumers are behaving week by week, because we've seen that consumers have really cut back, but we've also seen that they're now starting to spend more again. And there are kind of two sides to this consumer confidence. On the one hand, you can look at its level and say that consumers really aren't particularly optimistic. They're a bit cautious, moderate, and as you say, maybe they're looking for places where they can save their money rather than just spend it. That's kind of the negative angle on it. The positive angle is that there is actually a slight improvement in consumer confidence at the moment, and also an improvement that we think is well-founded and one we are quite convinced will continue, so that in half a year or a year, we'll reach levels that look a bit more respectable, even when we compare to previous times.
Well, Søren, it's funny you mentioned that, because that's exactly the middle ground we want to position ourselves in, where actually you called it negative to place the money in relation to consumer confidence. Yes, but that's exactly where we want to breathe life into him and say, well, here you can actually both place your money, but you can also spend it at the same time. You can absolutely take your aesthetics and your consumer, your applied art, home with you on your arm, while at the same time actually protecting your wealth or that investment. And you haven't spent the money in the same way as with that trip to Mauritius we talked about earlier.
I also find that this consumer confidence is very much dependent on expectations regarding interest rates. I can tell that sometimes I share Søren's predictions about where interest rates are headed. And I notice a great deal of interest among both private and business customers because they know how important a driver it is for what they're dealing with. Most people have noticed that their rent has increased significantly if they have adjustable rate mortgages in the past couple of years. And so people are they are very aware of what this interest rate means. And I also think that part of this, I also notice an increased confidence and willingness to spend money. And I actually think that's because people expect interest rates to fall, so they feel a bit more secure that it won't go up any further, but rather it's on a downward trend. I think that means a lot.
The walking crystal ball, that's Søren over there. What does the interest rate say? Where are we right now? How do the coming quarters look, and how far ahead do you dare to predict?
Well, there's a bit of a difference depending on where you look, and we divide it so that if you want to break it down, you can look at what you might call long-term interest rates. That is what is otherwise called the fixed interest rate. For example, the interest rate on a 30-year mortgage loan. And then conversely, you can look at variable interest rates. That could be a short-term interest rate or the interest rate at the bank or on a car loan and so on. And for the latter, we're actually quite convinced that it will also start to fall very soon. It looks like already now at the beginning of June, we're going to see interest rate cuts both in Europe and Denmark. And we believe that will be the starting signal for a few more to come. That means that this interest rate is probably on its way down. Not that it's going to plummet, but it will steadily decline over the next year to a year and a half. Whereas when we look at the fixed rate, the long-term rates as we call them, we actually don't see many good arguments for them to fall. The drops in the short-term interest rates are in some ways already factored into the long-term rates. And at the same time, there are actually many good arguments for why those rates should remain high. For example, one reason is that governments around the world will continue to spend a lot of money. This is especially true for defense at the moment, where there will be many investments, but also for the green transition and so on. These are the kinds of things that point toward interest rates remaining high. So we actually don't expect the interest rates to drop significantly, but that the short-term rates will fall somewhat.
And if you dare to look further ahead, beyond just a slight drop and then stagnation over, let's say, the next year and a half, what do people think about, say, a 5-year horizon? Where do we estimate we'll be?
Well, some would argue that we have a hard time looking even 12 months ahead, but if we dare to look a bit further ahead anyway, then we actually think there are some arguments now that the interest rate level we had before the pandemic, we won't be seeing that again anytime soon. It has simply moved up. So unless we get a really deep crisis, which is what it would take to get interest rates all the way back down to around zero again, well, then we probably have to get used to both short and long-term interest rates being higher than they were before the pandemic. And we could easily imagine that a short-term interest rate will stagnate around these 2.5%, and the long-term rate, well, around 4%.
And Ulrik, well, now I'm tempted to ask. It's very rare that I sit here with two bankers and microphones at the same time. So now I just have to ask you, how how does that fit together? When Søren says this, do your clients share that view of the world? I mean, are they mentally there? Is the mood such that it matches what Søren is saying? Or do people just roll their eyes a bit and think, we heard that one a year ago too? Or what do your probably excellent and highly skilled clients say when they hear this statement?
About the interest rate.
About the interest rate, yes, exactly. So do they share the sentiment? Are you on par with because the reason I'm asking is that the people you're talking to are, funnily enough, the same people we'd like to trade watches with, both buying from and selling to. So are they in sync with you?
Well, I actually find that people are positive. The companies, they don't experience, well, they actually find that this soft landing we've talked so much about, that's really what's happening out there in reality for the companies. They've slowed down a bit, but you could say they're ready for growth again. And I find that most customers believe that the coming years will be at least as good or even better than what they've experienced in the past couple of years. So absolutely, it fits well with that.
So we're ready to go full speed ahead.
Yes.
Awesome.
But Daniel, we actually work a bit in the same segment. Our private banking clients and your clients here at Urhandler and Invest, it's really many of the same types and the same people. What do you actually see matters to those customers?
I have a clear sense that one of the things that's important to them when they come up here to the second floor of the building after a successful meeting downstairs with you is definitely this extra layer of coverage. This somewhat safe and very little volatile haven, which perhaps still has a potential for this relatively high return. So people are looking for something else. They're looking for something different. They're looking for something more tangible. And that's what we need to keep in mind. Many of these, if not all of our investment clients at Urhandler and Invest, are owner-managers who either still run their business or in some cases have sold their business in recent years. And they are, well, in good Jutlandic terms, businessmen. And these businessmen can, of course, listen to and understand what both Søren and you, Ulrik, are telling us here today. But I think that what we can do up here in this much simpler setup is to speak directly to the heart of a businessman. Here we buy something with the intention of selling it again, either right away or within a certain time frame. And that really speaks to their business instincts, this physical collectible, and the fact that we are dealing with an easily manageable collectible that you can actually, well, if COVID were to break out, COVID-25, God forbid, in a version 10 times worse where we all have to wear gas masks, well, then it's just a matter of going down, grabbing a suitcase, closing it, and then you've moved your investment. And if you're sufficiently exposed in everything that both you and we work with, then I also think you find, if nothing else, a sense of mental security in actually having something completely physical and tangible. Whereas maybe 30 years ago, people would have gone for, well, you can still do that today, but would have gone for this completely physical gold bar and kept it at home in the safe. Well, now we have the opportunity to include more strategy, as well as some aesthetics, some applied art, and other values in this investment, while at the same time, at least historically, we've been well protected and have also outperformed gold for many years. So that somewhat safe haven combined with sound business sense, that's at least one of the things I believe makes people happy. And I also think that many of the investment clients I talk to at the moment, they are very happy with their stocks, which have performed really, really well. And then, especially last year, we had some quiet months in Urhandler and Invest where things were a bit less exciting. But actually, they themselves mention it before I even get the chance to tell them that this is kind of the counterbalance. And it actually makes good sense that when the stock market gets really hot, well, then maybe things are a bit less hot with the watches and vice versa. On the other hand, we made 19% in several portfolios and also 19% plus the year before, when it maybe wasn't quite as fun to be in the stock market. So swings and roundabouts, and it's just a really good way to hedge yourself. But there's no doubt that the common thread among our investment clients overall is their understanding of good business sense and their very low risk appetite, which we are fortunately able to accommodate.
And now I understand from you that the market is starting to bounce back nicely again. What kinds of customers are you seeing again now that you didn't see 6 months ago?
Well, the one I didn't see 6 months ago was this bricklayer Jensen, whom I always use as a good example. He actually still had a really good 2023, but despite that, he might have been about to say goodbye to an apprentice or two. And then you don't necessarily celebrate that with a gold watch costing 400,000, even though you made 6 million. He was kind of on standby in 2023, and many If I may be so bold as to say, at the other end of the price spectrum, watches costing 40, 50 or 70,000 kroner, the somewhat more affordable watches we work with, well, there was definitely also a tendency for people to want to wait and see. That sense of trust just wasn't there. People didn't necessarily dare to, take 70,000 from their home equity in Sydbank and then put it into a watch. And I can gradually feel how we actually in Q1 are significantly above budget in terms of revenue. And that's definitely because we're seeing these segments we've been missing slowly but surely returning to the market right now, actually earlier than expected. And that's incredibly, incredibly good for us if we can have both happy investment clients and, not least, happy end customers. Because in the end, one is somewhat dependent on the other.
So these investment clients you have, do they actually wear the watches? Do they even see the watches at all?
In the vast majority of cases, no. They see the watches and they have access to the watches. They have an online access where they can constantly see where the watch is located. Whether it's in the sales process, out for viewing, or in storage, down with you in the secure basement at Sydbank or wherever the watch might be. But from there to going clockwise, for example, they don't. Either the watch is put away to remain in the same condition in 5 years when it is to be sold, or whatever the time frame may be. Or it's what we call an ongoing investment, meaning it's immediately put up for sale on the market. And in that context, it's often VAT-registered holding companies. So it's holding assets. So therefore, they don't have private access to the watches, because then they would have tax-related control over the watch. Of course, that's not allowed. Then we'd also have to go around taking pictures of the watches every day, because the condition would change every hour you sit here and bang it against the table. Well, then there would be new scratches on it, and we would have to start all over again. So the short answer is no. Many private individuals use that route for capital preservation and have 1 or 2 watches lying around, seeing their savings in them. You can absolutely do that, but as a semi-professional or professional investor, if the watches are bought with the intention of resale, then of course it should be done as part of business operations, preferably through a holding company.
And if you have it in ongoing invest, then it's like you guys are the ones managing the portfolio. Is that a fair way to put it? So if you get a good offer, do you sell the watch without having to go and talk to the customer first?
Ongoing invest is basically a large commercial commission agreement. So essentially, from a legal standpoint, they are our principal. So whether you have 1 watch for sale with us or 250 watches for sale with us, it's actually the same legal framework behind it. That's one part of the agreement. The other part of the agreement is a legal power of attorney for repurchasing for the amount sold. That means we go out into the market, repurchase the watch we feel is appropriate for the investor, and sell it to the investor. And when I explain that, if I have to play devil's advocate in the room, that's often the question people are left with. Well, then you get to set the price yourself, and you could end up selling something terribly expensive to this investor. Yes, but I can only do that once, because the only way I can make money from that engagement again is if the investor sells a watch, and then I can sell a new one to the investor. So that's really the cycle, that's the circuit. So you're actually exposed to something very low in volatility, while at the same time, we have the opportunity to make a difference here, which you don't really have with a gold bar. We actually have the possibility to market the watch, change strategy, offer it with a focus on Italy on Chrono 24, if that's what's interesting. Or do some reviews of it here at home, if it's something that belongs in the collection of a collector up in Skagen, where we'd like to have it sold. So we have some other tools, while at the same time we ensure that the client is exposed to this safe haven.
That was simply all we had time for this time. A huge thank you to Ulrik and Søren for wanting to join us. And if this episode has sparked your interest in investing in collectibles such as watches, you can right now visit our website or Handler Invest and read much more. Thank you so much for listening. See you!